Well, good morning, everybody. It's good to have the broad-based warm-up, my friend Arif, this morning. So it sounds like you covered kind of the big picture of raising money from investors and sort of characterizing your company. I'm going to give you a little bit more detail in two specific areas. Let's see, which way are we going? What did I do? Didn't take that class at school. Oh, to the right, okay, good. So I'm going to talk, like I said, about market sizing and competitive analysis. This is a little bit of a review. I heard the word unicorn this morning. I think people use all kinds of terms. It doesn't come up that much in the day-to-day activities at a venture firm. But I think this is my spin on what Arif mentioned earlier. First of all, there's no recipe. I think that's the most difficult thing looking from the outside, looking into how institutional investors make decisions about investments, is there isn't a checkbox. Maybe close, maybe not. Sometimes it's just pure gut feel. Sometimes it's very, very mechanical and very, a lot of documentation, and it takes a long time to get through the partnership because there's so many questions and so many validating points. But the net is, there's kind of a framework. I think the great team thing, I think you get that. I mean, we're just looking for people that can get the job done. There was a comment earlier about if it's first time, how do we know if you're great or not? I guess that's the, how do basketball teams recruit, in small colleges and pick somebody who's going to be an NBA great, or all kinds of analogies. Not an easy answer. I guess that's just that's just a personal thing if you think somebody's going to be able to do it. But it also relates to the other other categories. So great product. Something that other people will talk about this too, but clearly something that matters. And why does it matter? The market's very big. It's different from other things that are out there. And then specifically, something doesn't always get mentioned. You might actually have a great team. You might actually have a really interesting product. It might be just a huge market, very differentiated, but your plan doesn't make sense. So all of that kind of has to come together. So today I'm just going to talk about big market and differentiated offering. So market sizing. This is one of those where you're probably not, it's not a showstopper. Investors will probably hold your hand and help you with this. I think this is one of those where doing the homework is just going to save you time. It's not, if the market's big enough, people will help you figure that out. But if it's not, it would be a shame to have spent 6 months or a year working on something and then showing up, thinking that you need 20 or 30 or some large $20 or $30 million or some large amount of investment, and you get feedback that the market's not big enough. So I'd say this is probably more for you than it is for the investors who probably to do it a lot and have a good sense of things. So this is just about are you I think Arif mentioned this, and this is something that for me, I guess I wasn't born a venture capitalist. I was an operating guy for a really long time. I've been at Venrock for about 6 years, sort of on the other side of the table. That ratio of what did Arif say, 5,000 deals? We're about the same size firm. We see about that many deals, and the ratio he showed of 5,550 is about the same as what we see. Okay, so 1 in 100, 1 in 200, those are I wouldn't call that the odds, because I think if you had a really solid story for each of those points I put on the first slide, I think that puts you in the top quartile on day one. So the raw number of deals we get, the 5,000 deals, that come over the transom, come in emails, cold, all kinds of things. So if you kind of do your homework, you end up in the top part and your odds are much better. So anyway, as far as market sizing goes, my point was there's lots of good businesses in the world. And I think one of the hardest things for me, and I think for a lot of people, is that not every business is a venture fundable business. I'm assuming because you're here and because of the talk, although you may not be here because you want to get funded by a venture capital firm. You may just be here because you're interested in starting a company and being really successful. Building a depending on what your needs are, $1 million revenue a year business, a $50 million a year revenue business, or you know, $1 billion a year revenue business, in your mind, might be really successful, might be fine. So I just think it's really, really key not to look at success based on whether you get funded by the venture guys. It's only an issue if you think your business matches a lot of the, you know, sort of the characteristics of needing the kind of money that, you know, that we need to invest. And it's really not part of my pitch, but I just want to point this out that, you know, when you're talking to venture funds, and I'll get into this a little bit later, when you're talking to venture funds that have $300, $500 billion funds and only have a few partners, each partner's got to invest $50 to $100 million in a couple of years. So that means if you've got, you know, you're probably going to have a couple of investors, a couple of different firms. So you're talking about 20, 40, $60 million of investment, right? So you really need a business that needs that much money. And that's sort of the, you know, one of the many guidelines that you use. Okay. So, yeah, this is the classic picture. I mean, it was the one that completely stays. So what is significant? $1 million, $100 million, $1 billion, $10 billion? What's significant? So Arif did the math. Let me do it again because it's really, really, really important. It kind of goes like this. If it's $1 billion market, and we'll talk about the market sizing in a second, what that means all companies in the entire universe or the world, you know, will spend, I'm sorry, not, I want to be careful to flip between market sizing, which I talk about revenue, and valuation. So here, let me just talk about valuation for a second. When we say when we want to invest in billion-dollar markets, we're actually talking about billion-dollar valued markets, okay? Not billion-dollar revenue, okay? We want you to build a billion-dollar business. So let me take it from 3 different angles. We're going to own a share of your business. Let's say we invest in the A round and we own 20%. B round comes, there's more money put in, there's some dilution, we're down to 15%. You get a lot of money later before you go public, we get down to 5 to 10%. If the company goes public at $1 billion valuation, our 5 to 10% is worth how much? $50 to $100 million. And if we invested that 10 to 20 million, there's our 5 to 10x return. So that's how we look about it. That's how we think about it. So in terms of when you walk into a venture firm and they say, you know, we want the possibility of $1 billion valuation, they're really not talking about market size. They're talking about what your company is going to be valued at when it goes public, okay? So when I say market size, I'm not talking about value, I'm going to talk about actual dollars. So we flip back and forth between those two, but it's very important to make that distinction. VC fund size, I just talked about that. Return commitments to the LPs. This is I don't know if it's a secret, but it's not supposed to be a secret. Venture firms don't necessarily publish what their returns are. I'm sure you read about this in the news, where if you're a venture firm and you have investments from public entities, then they have to publish what the returns are, and people like us in the public can see them. If you get investors in your fund that aren't publicly funded or publicly supported, you don't have to report your returns. So the question is, what do we promise our LPs? Well, we certainly don't promise them 100x their money, right? And if we promised them 1x their money, it wouldn't be interesting. If we promised them 120% of their money, they could get that in CDs over 10 years. So the promise is in the 2x to 10x range. And the top quartile over the last, venture performance has been kind of funky over the last, there was a period for 10 years from 2000 to 2010, where only the very best firms did better than break even. The average return was like just a little bit negative. And then there's been periods since 2010 that have been a little bit better, where you're getting multiples on your return, and during the go-go 80s and 90s, things were a little bit better. But the commitment is somewhere in the 2 to 10 range. If you can do better than 2, you're great. Top quartile is like 2 to 3x, just FYI, over average 10-year periods. Market share, I think Arif commented on this, you can't win them all. You're just not going to get the whole market. So anyone that comes in that says they're going to get 50% market share or 70% market share, kind of question that. And then the argument, which I'm sure many of you have heard, you can't say it's $1 trillion market and I'm going to get 1%. I mean, typically, even though that'll be a very, very big number, the way we just look at it is if you're such a small share of a huge market, you're probably not interesting, and it'll kill you even to get to 1%. Either people like what you're doing or they don't. So either you're material or you're not. And then time to liquidity, we kind of look at, well, how long is it going to take for your company to sort of develop? So if the market's not big enough, you won't find enough people to talk to about your product. So if you just sort of think about it as, I don't know, I can think of almost anything. San Francisco. If there's only, in the city of San Francisco, there's 1 million people. And if the market is small enough such that only 10 people in San Francisco are going to be interested in what you're doing, it's going to be hard to find them. So to get off to a fast start, you have to have a big enough market so you have a statistically relevant enough size of potential customers in any given area that you can get to them quickly. We always say, we're not flipping stocks, we're investing long term, and we need to, we're okay for your company to grow over a 7 to 10 year period. The caveat is we kind of need to see a little activity within the first couple of years to give us confidence that we should keep putting money in until you finally grow to however ultimately big you're going to be. So the $1 billion business, if I said, okay, let's say it's $1 billion market size. We'll talk total revenue dollars. So if it's $1 billion business and you look at some analyst numbers in 10 years, then maybe in 5 years it's going to be $500 million, and 3 years it's going to be $100 million. You're going to get 20% of that market, but you're probably not going to get 20% in year 2. You're probably only going to have 1% or 2. So 1% or 2 of $200 million is what? A couple $1 million. So if you have a couple $1 million in a couple of years, that's probably okay. It just seems kind of funny when you think about there's $1 billion going to be spent, and we're okay with you getting $2 million within a couple of years. Well, that's kind of how that math works. Your market share grows as the market grows, and the numbers get big later, but we need to see something early, and we need to see it get big. So this is a pretty easy one. I think it's pretty intuitive. What kind of markets are there? There's existing markets. There's the automotive market. People sell cars. There's the computer market. People sell desktop computers. You could decide, I want to go into a market that exists. I think I'm good at it. I think the other guys aren't good at it, and I'm just going to go head on and go at them. Generally, that's a tough play. I mean, there are people that, think about Apple and the MP3. They weren't the first player in the MP3 market, right? They just felt that they had something better. And the first iPods that came out were the 5th or 10th company that were making them. They just felt they had a better product. They just went head on right at the market. Resegmented markets. So a good example. You're selling cars, but you decide, I don't want to be just I'm not going to go head to head with the Detroit automakers. I'm going to resegment and just sell to those people who care about green. And I'm going to sell electric cars. Well, we know one of those companies, like a Tesla, they weren't going after everybody. They're selling cars, but they took the overall market, took a piece of it and said, we can be really good over here. So that's kind of, if you find sort of a specialized market, generally true, but you can say in that sector, you're better than everybody else. Completely new markets, maybe the drone market is completely new because before, or let's call it the consumer drone market, just didn't exist. The technology to do, auto stabilization and the communications with the drone, everything just wasn't there. You could do it for $1 million 10 years ago, but you couldn't do it for $300. So the market just didn't exist. So interesting. The only problem there is how do you predict what's going to happen? There's no history. And then clone markets, I think the easiest way to talk about that is someone in China wants to do Airbnb, and they just start another company that's exactly the same. Okay, so what makes a market attractive? Yeah, question.
What about the markets that are like evolving markets, which are not exactly new, but they're certainly not mature?
So I would say if you evolve, I just put them in the new category. Yeah, I mean, that's a good question. It's probably areas of gray. That's fair enough. So new, some specialized niche part of new, existing, some specialized niche part of existing, something relatively new, or something that takes a small part of an existing market and then sort of grows it. I just put that all in the same category. That's fair enough. So monetization potential. This is a really difficult one because I think we all know companies out there that are worth, again, I'll try to be really clear when I say dollars versus value, that have a value of billions of dollars, but they have no revenue, right? Well, that's this thing about monetization potential. If so many people are interacting with you, there are arguments, and I think it's been pretty well proven, although it's still hard for some of, I'm an old school guy, it's still hard to relate to making an investment in a company that doesn't really have a plan to make money. If you've got 1 billion people touching what you're doing, the argument is you can you can advertise to them, you can make offers to them, you could do lead gen to them. There's certain business models that you could do if you have enough people that are just interacting with you. The Twitter thing, just Facebook before even Google, before the monetization models were added. So it's something that we look at. This is one of those where if the numbers are just ridiculously big and you think you can do something where you can have, and here's the numbers that make sense. And I guess in today's consumer, and this is generally consumer related, if you're in the millions, single-digit millions, I think you're kind of talking interesting things. Because remember, ads and lead gen kind of things, we're talking pennies per click or pennies per view or pennies per interaction. So the numbers have to be very, very, very large to make it interesting revenue dollars for us to think is interesting. All right? So I can't give you exact formulas, but if you're talking about businesses that out of the get-go don't really have a monetization model, the numbers have to be pretty darn big, and you can do that math in your head. We see a lot of people come in with consumer deals. It depends on what kind of investors you're coming to, but for guys like us, sort of this mid-tier, 10 to 20 million over the life of the company, if you come in and say, well, we've got our product out there and we've got 20,000 people using it, unless there's another story that says, that's going to project out, it's very, very hard to visualize how we're going to get big enough numbers to sort of make significant revenue, to meet certain revenue expectations. Growth rates. This is another related to market sizes. I mean, this is a lesson. It's interesting. I was involved in the clean tech group at Venrock the last few years, and one of the core questions that I'm sure people asked in 2003, 2004, 2005, when the whole clean tech movement was kind of coming around, was, can you make money as an investor in the utility market? Well, I'll ask you, how rapidly do you think changes happen in the utility market? Well, you already know the answer. That doesn't change very quickly. What about the aviation market? Not that fast. I mean, we can think about a lot of historical markets that we all use every day. They're either very mature or just They just don't change quickly. And so that turns out to be a pretty big deal, and I think that's one where people are learning all the time, but from the clean tech perspective, that was a real big takeaway. No matter what people did, no matter what kind of products and what kind of ideas were thrown in, the general consensus in the venture capital community has spoken with their feet. They've kind of left this segment in droves. There's still some people left, but not a lot left. It just didn't grow quickly enough. So disruptive products and interesting business models just didn't matter. Market share, I think we talked about. Timing is a really big deal. You may actually have a really great product and everything, you got a great team, you got a great product, it potentially has a really big market, and some of these things are correlated. Maybe there's a regulatory change that needs to happen, like the drones. So that might just be a little bit early to invest in the drone market, maybe not. But arguably, if the government doesn't allow you to fly them, then how many businesses are going to actually be able to use them because they can't fly over 300 feet, or you have to stay in your own backyard, or whatever the constraints are. Healthcare, if you had some disruptive business or product related to a drug, and until the drug's actually approved, might be too early to invest. As a matter of fact, at Venrock, we're a very big healthcare investor, but we generally don't invest in drug development until it's past the toxicity stage and actually until later trials, because it just takes so long. Remember, our funds are 10-year funds, same as Arif said, 10-year funds with 1-year renewals. Well, it could take 20 years to get a new product to market. Battery technology, you probably noticed, continues to be frustrating to see if your phone will last all day, all day use, and why can't batteries get better? Batteries are one of those material science kinds of things that just take a long, long time to develop. The anecdote that I think I believe in is it takes 20 years for a new battery technology to come along. And there's hundreds of battery companies, but we haven't seen much, right, in terms of, it's very, very incremental. So timing's a really big deal. I'm going to talk about competition. Disruptive is kind of a qualitative kind of thing. Disruptive is, maybe I'll relate it, and I don't think there's any rule about this, but it's sort of related to, does it make you change behavior? Does it just change the way things are done? And there's kind of an old adage in the venture community is if you have to change someone's behavior, that's probably going to be a pretty hard slog. People are kind of funny, we like to do what we like to do. The when Harry met Sally kind of line of, I want the salad, but I want the dressing on the side, and I want this on the side, and I want this, and I want this. We kind of want what we want, and it's hard to change. And so for you to expect that I've got something that's going to make people do something so fundamentally different, right, it turns out to be a big deal. But when you've got it, it kind of matters. It's the disruptions we've seen in music, in the music industry. First CDs, then streaming, and just the models that people go to market with. It just changed the way people behave, but it was better. Regulatory we kind of talked about. And then markets, this sort of relates to the age of markets, and investing in markets that are already consolidating, where people are buying each other up very quickly, is probably a dangerous time. You kind of want to go into markets where lots of players are active, or there's lots of opportunities, versus, well, it's kind of a done deal. And I'm trying to think of what would be a good example of just it in current time of sort of what's slowed down. Oh, probably like search engines. For example, there's still a market in search engines, but there's a half a dozen players that sort of own things, and we're generally pretty happy with things. It's kind of a market that maybe you'd have to resegment it, right? Maybe you'd have to do something different than try to just go head to head with a market that's already established itself as this works pretty good or pretty well. Okay. This is the classic slide, but and Arif mentioned it, about how you define what market you're going after, what market you're targeting. So when someone says total available market, you can say anything you want. We're going to give you all the freedom in the world. What's the total available market for cars that can be sold in the world? Well, it's probably based on how many people of driving age, average driving age in every country in the world, And if, you know, half those people had cars, that's the total available market. The total average value of a car times the total number of potential drivers, that's it. Maybe that's one way to say how big the automotive market is, or the computer market, or, you know, the number of chairs that are sold in the world, whatever, just total. The classic, and Arif mentioned this earlier too, the classic faux pas that happens when people come in with market sizes is I'm going to get into the automotive market, which is a $1 trillion market, but I'm selling steering wheels. So what part of the total available market are you actually able to serve? So if the total market in the automotive market is all the total fully built cars plus the parts plus the service, and you're just selling steering wheels, it's something smaller than the total market. So we're interested in that piece. The total markets generally we're past that in 30 seconds. What we're really interested in is what market are you actually capable of serving with your product? It may be that if you're going to sell steering wheels, what you've decided to do is stay with race cars, because people spend a lot of money, or sports cars, people spend a lot of money on steering wheels. People who have Camrys don't typically change the wheel. But someone who's got a Camaro or some sort of, you know, fancy race car, they might want to put a custom steering wheel on there. So that's the target market that you're going after. You might branch out later to do other things, but that's the target market you're going after. And then there might be even there might be even a smaller circle here, which is the early revenue target you're going after, where you're only going after the race car community in Nevada, in Arizona, and in California. So that's the market that you're actually going to target, because the resellers or the salespeople you have only live here. Yeah.
So given this picture, when you're doing your pitch, and say that initially you've got this kind of like this huge market, target market, do you talk in your pitch, do you talk about that initial market, or do you actually talk about the SAM?
Yeah, so, I mean, we're going to get to that in a second, the kind of the top-down, bottoms-up. So this is kind of really what, you know, when you talk about the market you're going after, it's really the market you're going to serve. So just be careful not to sort of overextend and say, we're in the automotive market, that's huge. Well, no, you're not. You're really in this components market selling steering wheels or selling tires. That's where you are. Sort of the, you know, the big and tall clothing thing. You know, if you're in the clothing market, that's a ridiculously large market. But if every storefront you've got says big and tall on it, you've already segmented the market down to a certain group that you plan on serving, right? So, and then, like I said, just because you've got you're focused on the United States, and you got a whole United States worth of consumers that are going to buy big and tall clothes, or larger sizes, or plus sizes, or whatever, you only might be working in a couple states, because you've only, you know, so you sort of work your way down. But let me get to, so how do you actually compute these numbers? So this is sort of the pragmatic slide or two that says, how do you get the numbers? And I was thinking about how to explain this, and how I kept flipping back and forth to, there's no real formula here. This is kind of, yeah.
I can't hear you.
Oh, okay. That's better. Okay, thanks. I'm going to just change the story for 1 second, just to sort of get you on the path here. Let's not talk about market sizes. Let's talk about sizing revenue, because a lot of you have probably worked at companies, some of you probably started other companies, where you had to do your annual budgeting. Okay, so I'm not talking about markets right now. I'm just going to talk about revenue, but it's the exact same. It's kind of a proxy. It's an exact same way to do the analysis. So your boss, whoever runs the P&L for your business, says, okay, what are you going to do next year? And you say, well, let's see, we're going to sell, you know, we're going to sell Teslas, you know, and you're Tesla, and you're the guy who's responsible for all the Model S sales. So what you say is, well, there's there's 200,000 people in the United States that make over $200,000 a year. And those are the people we're going to target. And we'll get 20% of those. So, 20% of 200,000 is what, 40,000? 40,000 times $100,000. So what is that? 40,000 times 100,000 is 40 million. Well, it's a few, what do we get? So 40,000 times, it's a very big number, right? I was just going to, how many zeros? It's 40,000 times 5 zeros, so ridiculously large number. So top down. Bottoms up would be, well, let's see, we can't sell in New York because we only sell direct, and you have to have franchise. You all have been watching this in the papers, right? That certain states Tesla can't sell because they sell direct. In those states, you have to go through a dealership. So, okay, you have to take those states out, and then you have to say, well, we only have so many sales guys, and each salesperson could probably close about 4 cars a month. There's your bottoms up. So that's your bottoms up revenue model, right? So whether it's for each city, each state, each whatever. Let's go to markets, because that's what we're here talking about. Same kind of thing. What I would just say is, top down is when you kind of wave your hands. You'll know it's top down because you're waving your hands. That's the signal. Well, this is a really big market. We're going to sell, a $1 item to every person in China, right? $1 billion. That's top down, right? We're going to how many electric cars will be sold in the United States? Well, 10% of the drivers in the United States have kind of green feelings, and so 10% of our car buyers. That's going to be the size of our market because it's 10% of the total, and it's about this much. It's top down. I don't have a better way to describe top-down analysis except it's that sort of hand-wavy, visual, it's, what did I say over here? Proxy markets. Well, this many people have solar cells or solar panels on their homes. Those are the same people who are going to buy Teslas. So we know if there's that many homes that have solar cells, probably that many homes that would potentially buy an electric car. Or buy an electric car, and then Tesla's going to have 30% market share, and that's your number. So that's kind of your top down. Bottoms up, very practical. How many salespeople do you potentially have? And then again, it sounds like we're confusing revenue and market size, but it's sort of that kind of thing. How big a company can you build? So if you can only, if you can build a company that has 1,000 employees and you've got 100 salespeople, and 100 salespeople have the potential of, each having a quota of X dollars, you sort of work your way up from the bottom and come up with a number. And then we rationalize those two, all right? So both things happen. I mean, I've seen both in meetings with entrepreneurs that the numbers are ridiculously big and we don't think you're ever going to get there, or you're very, very grounded and you come up with a bottoms-up number, which happens all the time too, where, geez, a $3 million business in 5 years? Geez, that just doesn't sound big enough. That just doesn't sound interesting. But when you look at your model and your spreadsheet, you've showed all the salespeople, and you've showed what they're going to do, and it seems really reasonable, but it's just not a very big number. So somewhere in the middle, I guess it's sort of the Indiana Jones movie. I don't know which one was. Oh yes, my favorite one, with the cup of the chalice, the cup of life. What is thank you, the Last Crusade. That he has to pass, 3 tests, and the last one is there's a gap between the cave where the prize is, crossing the chasm, and he has to step out there because he doesn't know if he's going to fall 100 feet, into the river, or is he going to make it to get the prize? And he puts his hand on his head and he takes a step, and it turns out he's okay, and he always wins. It's Indiana Jones. But that's kind of the bottoms up, top down thing, and that's where you have to be either you're a real visionary and you got this big number, but you're going to have to be a little bit pragmatic, or you're a very pragmatic person and you're trying to do it, a real honest bottoms up. This is what I can commit to, Mr. Investor. I know I can deliver this many $1 million. You probably have to push yourself a little bit. So there's probably some magical number in the middle, and there is no right answer. I think Arif even mentioned, I kind of have it's not a joke, but it feels like one, where I tell people when they see their financials, and someone's going to come in and talk about financials a little later today, is if you come in and say you're going to do $1 billion in 5 years, we're probably not going to believe you. If you say you're going to do $1 million in 5 years, we're probably not going to invest in you. So what's the right financials? I'll give you the secret. Write this down. This is absolutely, you win every time here. Okay? And our reach numbers weren't far off. So if you go years 1, 2, 3, 4, 5, and you say, 100,000, 2 million, 15 million, 50 million, 80 million go public. If you're in that zone, for companies our size, with what you just fit. And then it doesn't matter exactly what the numbers are, it's how you explain it. So again, nobody can predict the future. We're not looking for people that can predict the future. We wouldn't make that many investments if we, because there's no one to be found. But what we want is people that can say, this makes sense, bottoms up, tops down, and how you rationalize it. And if you get numbers kind of in that range, based on the fund size thing and the LP stuff I talked about earlier, it kind of fits. So the funny thing is, of those 50 deals or 20 to 50 deals that Arif mentioned, that and I kind of confirmed that we sort of do at Venrock, we do like one a month or maybe a little bit more. So maybe we do 20 deals a year. If you looked at the financials, sort of the year 2 to year 5 financials, they're probably all identical. I mean, not exactly, but you get the idea. Okay, get this down. Get this down. This is the winner. No, I mean, it's kind of the couple years in, couple $1 million, 3 or 4 years in, 15, $20 million, 5, 6 years in, 30, 40, 50, 60 million, in those zones. It sounds really bad, but it's really true.
That number is the top number of sales.
I was giving you top-line revenue numbers. And obviously, the different business models and things, there are models where you have pass-through dollars, where, like Uber, they have to, it was the Groupon numbers, right? There's things like that where the total dollars being spent in and around your business could be $1 billion, but you get 5% commission on every sale. So sometimes top-line numbers are even a little funny, and the Groupon one is the one I remember was the biggest issue in the press. Was it $1 billion revenue company, or was it really a $50 million revenue company because they only got 5% of every transaction? What was their actual revenue? I know that's not really what you asked, but I think this is an important point. I was just giving you numbers. This is your company revenue top-line numbers, not necessarily. So if you get a percentage of some transaction, we don't want, in a banking business, like if somebody's got a business that's, we see a lot of these, allowing people to send money back to their relatives in Mexico or the Philippines. So money is transferred, between markets. So like a Western Union type business. There might be hundreds of millions of dollars transferred, but your particular company only gets a percentage of the transaction fees. That's your revenue line, not the total activity. Okay. I think we're doing fine. Yeah, question. Yeah, so this is the valuation thing. It's a whole another topic. It's probably a pretty interesting one, but let me give you a quick answer. We're a fund, and we're regulated by the SEC. We have to give, just like you have mutual funds, you get a letter in the mail every quarter that says how much money you've got in your fund, what the value is, because it's usually publicly traded stocks. We actually send letters to all of our LPs every quarter and tell them what the value of their investment is. Well, if our companies are all private and they're not traded, how do we know what the value of the company is to tell you investors in our fund, Mr. and Mrs. LP? How do we know what to tell you? I think that was what your question was. Well, the answer is relatively straightforward. It's very similar to public company valuation. It has to do with top-line revenue, how much growth there is in your business. If you're going to do 50 million this year and the market's moving so fast, you're going to do 150 million next year, so it's this incredible growth rate, you're worth more. Software companies are worth more than hardware companies because of inventory risk. Markets that are hot, like internet security, might be 5 or 8x times top-line revenue versus computer manufacturers like Dell and HP on the computer side of their business might be 2x revenue just because the margins aren't very high, which are always also related to gross margins. So the valuation numbers are in one part due to revenue, but also gross margin and growth, people's feel about the historical, not historical, but the future prospects in that market. Not complicated, but it's a half a dozen factors. Yeah. I think we beat that to death. Okay, second half here, competitive analysis. This one is important in the sense that you have to decide it's not so much whether people like what you're doing, but whether they like it better than what somebody else is doing, or what I thought I'd come out of the gate and say first here is, in one hand, you're competing with people selling the same product. So Samsung and Apple, and there's a new Chinese phone manufacturer, I don't know how to pronounce Xiaomi, what is it? It's the most valuable private company in the world now. I think it's valued at $46 billion. They're all selling phones. They're competing directly with one another. Competing for the same market might be the communications market. Well, maybe I won't use a phone. A cell phone. Maybe I'll use a landline phone. So it's kind of a bad one because none of us hardly use that. Let me see if I can think of a competing for the same market. What do you spend your time on? So movie theaters compete with each other. There's Century Theaters and AMC's and whatever, but there's also bowling alleys and skating rinks that are competing for your time. So if you're a bowling alley and you have such a fantastic value proposition and people and parties and birthday parties and whatever just want to go there, you're literally going to take business away from the movie theaters, right? Because you're not going to go to the movies, you're going to go bowling. So you actually have to make a case in most business plans for both sides of things. You have to do it separately. You have to say, for the people we're selling directly against, we're just downright better, and we're going to win because of A, B, and C. And because of these other markets, yes, people could do that, but they're going to much rather do this. So you're going to actually have to cover both. I thought the next couple of slides here I just thought were kind of fun. They're eye charts. But I don't know if most of you have probably seen these Lumascapes. I'm not sure, there's different names for them. But they've become very much in vogue now to get sort of a quick snapshot of who's out there in the market. This one was kind of a search engine, SEM kind of marketing, very focused on search. And you can see how they're categorized in different areas, but it just kind of gives you a sense. And by the way, you might also say, total available market, served available market, right? You're going to, this is the car versus the steering wheel. Here's all the people sort of working in markets related to search engines, but there's different segments. And clearly, I'm trying to think of ones that are just very, Google is a tough one because they're in so many different businesses and it isn't always so obvious. But let's say just Bing as a search engine versus analytics that tell you how you're doing with your search, or are you selling to businesses, telling them how effective they are? Just different businesses. This is my favorite one. I thought you'd all get a kick of it. So, marketing landscape. Think there's a lot of marketers out there? This just cracks me up. But, so if you have a marketing business, I guess better be good. All right, the next couple slides here. These are not have-to-haves. These are just, they're not even nice-to-haves. They're can-haves. So how do you quickly, remember, everybody's got their standard pitch or every VC's got their standard, line of, give me 10 to 20 slides. Arif mentioned the elevator pitch better be less than 30 seconds. You've got 1 hour to pitch. You've probably all heard this before. You probably should have a pitch that lasts 30 to 40 minutes if you're talking to yourself in the mirror, because there's going to be questions and you get a 1 hour time slot. And that's usually for Series A, Series B. You're going to get follow-on meetings, but you've got to tell your whole story in an hour, right? So you get 40 minutes to actually talk and then 20 minutes to answer questions or just for contingencies. So how do you get the point across that you've thought through some of these market sizing, competitive analysis kind of issues? So this is a, classic historical, strengths, weaknesses, opportunities, and threats. I'm not going to go into a lot of detail here. I just have an example. Here's one. Sorry, the slides cut off a little bit. Walt Disney. I mean, we all know Walt Disney Corporation. They run theme parks. They have content in terms of movies and music, all kinds of things. So why are they strong? It's a brand we all know. They're very diversified. They're kind of known as a leader in animation. Goes all the way back to Mickey Mouse in the 1920s. Strongly identified in their segment. Why might they be weak? Well, the internet, over the top, the internet, the number of people that have different content, the ability for people to create animation without having artists, decline of cinemas, different ways to view things, and maybe Walt Disney hasn't gone after all the different platforms. What opportunities do they have? Well, all kinds of cheap ways. There's alternative ways to deliver their product to the marketplace. You got emerging markets who never heard of Mickey Mouse. They probably heard of them. They probably haven't seen much of them. And what kind of threats? There's the piracy stuff, changing animation trends. Anyway, it's a nice way to sort of characterize the landscape. And I would emphasize that these kinds of slides, and I'll show you a couple more, are helpful in getting through your 40-minute, your /1 hour pitch without having to wave your hands too much and sort of getting the point across quickly and presenting yourself as thoughtful. This one, we see this more often than not, and this is the philosophy of this kind of a chart. It's also cut off a little bit, but this is for software tools that track bugs in software development, okay? So every software development team has to keep track of what the errors are in the software, and then over time, before you release the product, or even after you release the product, you have to prioritize and fix the bugs, all right? And you have to keep track of them, tell the boss, tell the customers, tell whoever that we're making progress. When you're talking about competitors, how many competitors should you present? We saw that one slide. Obviously, it would be the kiss of death if you presented and you put that marketing thing up that had, 5,000 names in it. Probably going to scare away any investor in about 2 seconds. On the other hand, if you come in and say, I don't have any competitors, it's also not good. It's my classic, saying you don't have any competitors is effectively saying the market's not interesting. There's a few caveats. If you've worked in a lab for the last 40 years and invented something that no one's ever heard of and is just completely new, maybe you don't have any competitors. You probably have indirect competitors because people are still doing things the way they're doing, and you're going to everybody's using up 100% of their time every day, right? So if you've got something new and you want them to change behavior in terms of a service, you're going to steal the time away from something. So there's probably always indirect competitors at a minimum, right? How many should you put up? My best guidance to you would be not so many where it looks like, oh my God, and I'll give you a number. Probably not a good idea to have more than 10 competitors identified. You probably haven't segmented your market tightly enough. There's another classic marketing line that says, identify a market that you're the best, brand it as, not necessarily a new market, but brand it as a market that you're going to own, and then identify yourself as the best player in that market. So what you do is you keep whittling down the size of that total and served available market till you get to about 10 competitors. Then you know you've arrived at the right market. That's not universally true, and we could probably come up with examples where there's hundreds of competitors, but I'm talking about legitimate competitors. Another way to say it is, and we ask this of established businesses, we're fine, of established businesses, is when you go to make a sales call, who else do you see? So not necessarily who else is out there doing stuff, but who do you see? Because those are the competitors that matter, that are fighting for your customer's dollar. So that's probably a good list. So when you went out there starting your company, you started talking to people about what you're doing, and they say, well, so-and-so does that, and so-and-so does that. Well, they're probably competitors. Right? So not too many. the feature sets also, not too many. This is probably almost too many. The idea is, if you hadn't figured this out, and it's the classic thing, it also makes you smile, is whose slide do you think this is of the companies across the top? Any guesses? All right. They've figured out a segment where they do everything and everybody else doesn't. Okay, I guess I'll pick that product. All right? Yeah. Oh, well, you mean so, but yeah, well, what we might say is, might be a great company, but the market's a lot smaller because they're only selling to people who only care about that one feature. So it's.
They only need one more feature to...
Oh, I'm sorry. It's the other way. Yes, no, I understand your question. Yeah. So somebody might looking at this saying, oh my gosh, so are you seeing these guys a lot? Are people buying that? How are they doing? Is that well managed? Are they out? Are they growing? And then you might say, yeah, but they just lost their CEO. He just went to be the CEO of Google. So they lost him, and they're going to fall apart. I don't know. You're going to have to find. You either segment differently, or you got to come up with an argument that says you're still going to beat them, right? Or that the market's big enough for two players. Yeah, it could be. I don't see this one as much. It's interesting because it gives you a multi-dimensional look of multiple features at the same time and who's kind of got more. It's the same as the previous slide. It's really no different. This one probably gets the most press. Gartner, the big research group, they have this Gartner's Magic Quadrant, and it's a quick way to identify companies in your space based on two dimensions. Can they execute on getting product to market, getting customers, building brand, and do they have a vision? How broad is the product offering? How long do you think they're going to be around? Do you think they're well established? So I just did one here. This is for our customer relationship management software. You recognize some of the names. So Salesforce is way out to the right, smaller startup companies down to the left. I mean, the idea typically is you'll see startups over here where they've got big vision. We're going to take over the world, but they're only 10 people or 2 people or whatever. And so relatively small. You'll often see the bigger companies. There's not, in this one, they're all different. You see big companies where they're established and they're executing, but maybe they're just niche. They just do one thing. So this is pretty popular. It's pretty nice, and you can just quickly show the landscape of who's out there, and people will just kind of pick at it and say, well, what do you think of these guys? What do you think of these guys? It just creates a conversation quickly. So good to use in presentations. So how do we decide who the winners are in a landscape where you're not the only player? What do we do? So freedom to operate, I'll just start with that. Patents. If someone owns the seminal patent in a certain market that says, I'm going to make one up, there's probably a patent for it, but I actually don't know specifically what it is, that's putting information on the lock screen on your cell phone. If someone owned a patent and nobody else could do that, if a company came out and had some interesting features that when you just powered your phone up, you got the screen that says what the temperature is and what your schedule is, and I know there's people that do similar things. Boy, that makes it awful difficult to compete in that market if they've got the patent that just locks everybody else out. It's a pretty big deal, okay? So anything you can do to sort of protect yourself in terms of intellectual property, pretty good. Sustainable advantage. Is this a product that's going to be around for, is it going to be around for a while? Is it an intermediate product? We had a company come in, it was interesting, a couple of years ago. They had a really neat way to speed up archival storage, like for tape drives. It was super efficient way to store lots and lots of data very inexpensively. And if you're not old school like me, tape drives, people used them 20 years ago. Now we have hard disks, now we have solid state disks, all kinds of things. But it was pretty interesting because it was a very novel approach to making tape drives really efficient. Well, no matter how good you make them, the technology in that market is moving so quickly, they might have a couple-year window of having some sales, but we know that storage technology changes every couple of years, so how sustainable is that? Probably not. It's probably hard. So we're always looking for, are you going to be around for a while? The regulatory climate, oh, the question.
I have a question regarding patents. I spoke recently with two M&A guys.
Yep,
Large,
mergers and acquisitions people, yeah.
I asked them, how important are patents to you?
Yeah, so here's my spin on it, is that, so as venture guys, we generally, I'm just saying generally, I mean, I would say 98% of the venture people, we're not going to be aggressive on the plaintiff side, you know, going after companies that are infringing on our patents. We like patents because it sort of speaks to, there's at least someone out there, the patent office, that says this is a differentiated product, that no one else has done this. Now that's kind of a funky system, it's another whole story. Having some well, it depends on the markets. In enterprise markets, it's probably pretty interesting. In consumer markets, it's less interesting, although it could be. I mean, in the cell phone market, there's lots of patents. In the lighting industry, it turns out they're very litigious. There's tons of patents. Obviously, in the biotech market for drugs, tons of patents. But in some markets where, you know, you're talking about another social networking, you know, kind of play, but you've got some, you know, the difference between WeChat and WhatsApp and Snapchat, and hard for me sometimes to see the differences. I'm not sure if patents would really help you. It's first out there, get big quick, build a brand. So I would say most of the time we like to see patents if it's markets where you could, you know, keep people away, versus if it's a market where it's just get big really fast, it probably doesn't matter. But very rarely would VCs look at patents like, oh my gosh, we could go after everybody. We just don't look at that.
Product designer, I take my IP and figuring out better ways to present user experiences. So is there a way when going after a specific market or representing a user experience around what is the problem we're trying to solve? Are there any resources that we can go to protect the actual user experience of things, or on the product design side?
That's a great question. Hard to answer. I think it's a bit soft.
Excuse me, can you repeat the question?
The question was related just in terms of technology patents versus use, kind of, there's actually names for this, sort of, it's a kind of a design patent, how you do something, a process patent. Is that what you're asking about? Yeah, and so I'm going to answer it this way. It's not a great answer. So the Patent Office has been around for a long time, and they have very specific models for, and there's method patents, and there's device patents, and then there's sort of process patents, and the rules change every 10 or 20 years. I'm not really good with the process patent stuff. I'm more of a hardware guy, so I've done a lot of work with sort of just physical inventions or even an algorithm kind of thing. But in terms of how you do something, user experience, I'm not sure that there's a good overlap with the current patent. Yeah, remember, so it turns out I do expert witness work on the side when I'm not, when my wife lets me use vacation time for something other than, you know, being with the family. And I would say this, in the end, the patent system's a jury trial system. So it's like anybody can sue anybody for anything. It doesn't mean you're right. So you're asking a question, well, geez, rounded edges, that doesn't sound good. a lot of the times these things, if somebody has enough money, they just get to a jury, and then a jury decides whether it's right or wrong. If you watch Law and Order, you know, it doesn't matter whether it's right or wrong, it's what the jury says, and that's it. It doesn't matter if it was legal or not legal or okay or not okay. It's what, so the system we have in the US on those kind of gray edges around the outside, like process or things that you appear to be common, it comes down to what a group of 12 people say. Yeah. Okay. So anyway, I wanted to point out one other thing just about funding. There's a huge competitive advantage if any of you watch poker on TV, or, you know, it's the kind of the quote-unquote big stack rule. If you're at a poker table with 9 other players and you've got $10 in your stack and they each have $1,000, it's going to be hard to play in that game. Even if they've got nothing, they can just bet more than you've got and you're toast. And statistically, ultimately, you're going to run out of money. It's the same thing in the venture world. If we don't think you can raise enough money to be competitive with the other people who are raising a lot of money, it's a huge, negative on the deal. If we think you can raise a lot of money and maybe just have a so-so product, but you're so dynamic and your team is so fantastic that you can just outbrand and outsell the other guys, then that's a great thing. So funding matters. Having enough to play in the game matters. And depending on the market you're in, some markets you have to have a lot of money to play. Snapshot in time. This is just an important one. Are we okay? 5 minutes? We're good. We can make it. This one is really important, and people, it's not a showstopper. No, you won't lose getting funded over this, but I think it would show some thought if you make sure you say it this way. Companies come in, and they're new Series A startup. They might have a prototype, maybe a minimum viable product, but not the complete product yet. And they come in and they give the pitch to us, and they say, this is what we've got. Well, you don't exactly have it. You'll have it in a couple of years. You have to get it to market, you have to beta, you have to fix the bugs, you have to get the market to recognize that you've got a product, and then you compare it to what Cisco's got, or to what Google's got, or to what Salesforce has got, and they're selling it right now. Well, there's like a time shift, right? You have to do that extrapolation for us so that we know you're thinking about it. And the other way to look at this is put the stake way out there. I think for most, there are different markets that have kind of different rules of thumb, but software is developed much more quickly, right? So we're going to kind of look at the state of the market 12 months out. If you walk in and say, I'm going to do something, you don't have a product yet, you'll probably have something in 12 months, roughly. Unless you're really trying something dramatic, but you'll have something in 12 months. Whereas if it's a hardware company and you're building something to compete with Cisco, it might be 3 years. So we're going to look 3 years out. And where are you going to be there? So you better come up with a product that's so unbelievable that in 3 years, it's still going to beat the incumbents, who, by the way, have their own R&D, and they're spending money, and they're not telling you what they're doing. It's buried in some lab somewhere with the door closed, and it's going to pop out. And the last thing we want is to have spent $20 million over 3 to 5 years. You build your product, and the day that you announce it at the trade show, the big guy announces the exact same product, and they have 10,000 salespeople, and they have all the money. Not good. So you really got to be aggressive. And that's another one of the reasons, not in the slide deck, that we like people from consumer probably doesn't apply, but in enterprise and other kind of service businesses, if you come from the industry, we have a better sense that you know what's coming, right? Or at least somebody on your team who knows that space, because that's one of the biggest fears, that by the time it's ready to go, there'll be something out there just like it. So last slide. So here we are. So this is the VC speak slide, which always makes people smile. When we say something, should you take it for face value, or should you try to guess what we're trying to say? And I would argue the best thing is just keep asking questions until you understand what your status is. Are you going to be funded or not? So so what you hear is, who do you compete with? That's a reasonable question. Who's your competition, like we just talked about? Well, what are we thinking? We kind of already, here's another interesting thing. Your highest likelihood of success with any company and any investment is if the firm or the partner has already done investments in that space and is tracking the space closely. Because remember, most institutional investors are investors are part of partnerships, and the partnerships don't. The partner makes the decision. The partnerships vet it just to make sure it's kosher because everybody's taking money out of the same bucket to invest in your companies. You need to. Okay, I've lost my train of thought here. Right. When you're speaking to that investor and you've done your homework, as Arif said, and you've looked at the bios, and you know, if you're coming to Steve Goldberg to talk about Wi-Fi hotspots, or you're coming to Steve Goldberg to talk about data analytics because he's kind of a signal processing guy, I probably know a lot of the companies. I've been tracking it. I've been reading the news mostly, and you probably can talk to me at a fairly high level, right? Because I know the competition, because I've been looking at this space, because I couldn't make an investment decision quickly enough for you if I didn't. So it's unlikely I'm going to invest in a consumer play, because I don't really follow consumer markets. I don't have any experience in that space. So if you're talking to me about a consumer market, I'm the wrong guy. So when you say when I ask you who do you compete with, I kind of want you. I kind of know the answer already. I've seen 20 other companies. 20 is an exaggeration. I've seen 3 other companies in the last 6 months with the same pitch as you, because they all came in to see us. I just want to know if you know, right? And it's not supposed to be a trick, and different investors are different, but I want you to kind of give a sophisticated view of, when I say who do you compete with, I want you to really tell me, well, of course we compete with this, this, and this, but this is why we're going to win. Who will you compete with tomorrow? That's the classic. Are the big guys working on this? So you want to say, you want to just get it out there. It's the elephant in the room. If you're in the advertising business, or in the, or if you're in the, I'll pick anything, in the electric car business. The classic thing when I was heavy duty in the operating roles, where what's your Microsoft story? Because Microsoft was in so many different things when Microsoft was more relevant, still relevant, but they were much more relevant. Maybe it's a Google, Facebook thing now, is that, what are they doing? You got to know what the big guys are doing, because, I mean, Google has got the Google X stuff. They've got so many things going. We want to make sure that you know that they're not going to surprise us. And then finally, this is the question about the dollars. So-and-so just raised $50 million. What do you think? What we're really asking is, are you going to be able to raise $50 million too to compete with them? Are you going to? And the other interesting thing is, and this is a subtlety you wouldn't know, is most firms don't invest in conflicts. So if we have a company in a given space, we generally don't invest in another one, because they kind of get mad at us, like we're, which kid do you like better? Which sibling do you like better? So we tend to not deal with conflicts. So in certain markets that have been around a while, if 5 out of the top 6 firms that invest in your space have already made a bet, and we give you money, now we're a little nervous, because in the next round, who's going to be able to invest, or are we in there all by ourselves? So you'd like it to be, you'd like to go into a restaurant where there's some people eating there, but not that it's so crowded that you have to wait for an hour, right? So this is, you'd like to have markets where there's some activity, but it's probably early, and there's still some freedom to get investors for your next round 12 to 18 months out that aren't already conflicted. And I think that's it. So, thanks.